You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Pierre-Paul Turgeon, an exceptional guest and multifamily investor, former CHMC multifamily underwriter out of Edmonton, Alberta. Please help me to welcome our guest. How are you, Paul? Pierre.
I'm fine, Adam. Yourself? How are you?
Thanks so much for being with us today, and I appreciate you taking the time.
My pleasure. My pleasure. Thank you for having me on your show.
Thanks a lot. So I would like to start about the beginning as a multifamily investors, and maybe before when you were an underwriter. What was the beginning for you?
That's a great question. I'm going to try to keep the answer short because my path, my trajectory, it was quite interesting. I got a lot of education. I got a law degree, a degree in political science from a major in international relations from U of T. But I came out of the university, and CMHC was starting an international division, so helping foreign countries develop the similar kind of housing finance system that we have. So I started working for CMHC International at their head office in Ottawa, where at the time that's where I got my law degree from. And so CMHC was mostly, housing systems and all that, because, CMHC is Canada's national housing agency. But then CMHC was being approached. This is pretty cool, actually, Adam, by international institutions such as the World Bank and its subsidiary, which is the International Finance Corporation, IFC. And they wanted CMHC to provide mortgage default insurance, which is what CMHC is known for, advice to foreign countries, such as one not too far from where you grew up when you were born, West Bank and Gaza. Okay. So I helped. And I don't have it here with me, but my claim to fame is I met with Chairman Yasser Arafat in the Gaza Strip. Whoa. Because I helped create PMHC. So the point is, I work on behalf of CMHC on an international housing finance projects. So I said in Middle East, in Africa, in Gabon, in China, in Europe as well, in Mali, Africa. So pretty cool career at CMHC. But at that time, I was more a project manager on behalf of CMHC. So I wanted to learn the expertise that CMHC has, which is mortgage default insurance. So in other words, CMHC does not provide money to investors or borrowers. They insure the loans and the banks provide the money to the investors or the homeowners if you go with single home ownership product as well. And so because I wanted to deliver on these international projects from a technical point of view, I needed to learn CMHC's expertise, which is becoming an underwriter, which is assessing the risk factors when you buy a single home. I did a little bit of single home underwriting as well, then, which is pretty cool and often is not paid much attention to that. But I manage a small department at CMHC in the Prairie region called default management and real estate department. So two components. Default management is default management of apartment buildings. And here's the thing, Adam, very few of them ever defaulted back then. And to this day, despite the challenges that we have, COVID and you name it, and recessions, apartment buildings are a very sound asset. But I also manage defaults of small or homeowners products. So I learned the core expertise by becoming an underwriter. And then, of course, my last 4 years at CMHC, I was an apartment building underwriter, an apartment multifamily underwriter on behalf of CMHC. And then I saw how much money people were making owning and operating apartment buildings. So I left my job and I focused full time on investing, as you said in my introduction, on investing in apartment building. I own a portfolio of $22 million, 136 doors in the city of Edmonton. So that's sort of my long-winded story, but pretty cool trajectory, I find.
Yeah, I think it's a really, but you coming from, I think, Vancouver, not Vancouver. Yeah, Vancouver. You coming from Vancouver?
Quebec originally, or Ottawa, right?
Oh, okay.
Ottawa,
okay.
Across over the river.
So why you shift your whole portfolio to Edmonton or Alberta instead of Quebec?
Well, so what happened is when I wanted to learn, so that's one piece of the information I didn't share with you. When I decided to learn CMC's core expertise, again, which is mortgage default insurance, I moved from Ottawa or Gatineau. I lived in Gatineau, but I worked at CMC's office in Ottawa to Alberta. So I moved to CMC's regional office in Alberta and Calgary. So hence, that's what I know well. People in Alberta have done very, very well. The last 6 years have been very difficult. I'm not going to deny that because of when the price of oil dropped and there was an oversupply of oil around the world starting in 2015, 2016. But we have a very permissive legislation in Alberta that is, you can increase your rents by whatever the market can bear based on, what's going on in the economy, vacancies and all of that. But the province does not cap by how much you can increase your rent.
Yes.
So in the big boom days, which we're at the beginning of a new boom in Alberta, you could increase your rents as much as the market could bear. And I can give you a stat. The last that I looked between, I think it was 2004 until 2011, I think rents increased by about 44%, Adam. Yeah. So you imagine that, apply a cap rate to that. It was amazing. Vacancies were down. Some of the highest wages in Canada to this day are in Alberta. So the market could support these higher rents. And it still is the case. We have, like the rest of Canada, we have labor shortages. But so Alberta
market fundamental was there.
Very strong, very strong, and they're coming back very strong again. To be honest with you, I can expand on that if you want to talk about market fundamentals. But I was underwriting in 3 provinces: so Alberta, Saskatchewan, Manitoba, and the Northwest Territories and Nunavut. So it's a market that I knew well, and I think you'll agree with me. You need to know your market very well. So Alberta had opportunities, and I know it well because I was underwriting in that market. I knew everybody, and everybody knew me. I had a good credibility. So that's why I'm in Alberta. And I have great faith in Alberta right now. As I said, we're at the beginning of a boom again.
I think this is a great advice from experts like you is when you're looking on a multifamily, the big game is, or the main game is cash flow. You cannot work with appreciation. That's why someone like you was on the back end, CHMC, he saw and he knew where is the actual game is. And when you started to be an investor, your first thing is you moved from your or like Quebec to the game where is the actual market is investor friendly. The rent, as you mentioned, is there's no limit. And I'm gonna leave this for you to explain what is the market fundamentals, the main market fundamentals when you're looking to your market.
Sure. And before I do that, though, Adam, I hope you don't mind, but I'm going to somewhat disagree with you. In terms of, obviously, you want a property that's going to cash flow. Absolutely. That's I tell my students, don't touch a property unless it's going to cash flow. If it doesn't cash flow, it's because that maybe you can fix the property or raise your rents, or the market is turning in your favor. So we've got, again, strong fundamentals in the marketplace. But I'm curious now. I'm going to flip the question over to you. Why do you think it's only cash flow and appreciation not something that you look for when you buy a property? Is that what you're telling me? I'm curious now. How a bit of a reverse.
No. For me, it's the main question is my main issue about the cash flow always is the stability of the market within the recession cycle. So within your goal is the cash flow is going to be up and down with the recession, with the interest rate up and down. So why cash flow? Because you want to protect yourself during recessions. You want to protect yourself during any interest rate spikes. Because when you're dealing with multifamily buildings, you are not dealing with your own money. You wanna be trustful. You wanna keep the promised and projected returns to your investors. So if you're gambling, don't gamble with your own money. And for me, gambling is working on appreciated market, not a cash flow market.
No, I think that's it's a sound advice in that regard. You and I both use other people's money to buy these assets, so it's a very sound advice, and I certainly agree. You got to be very cautious. But cash flow, what I say, and of course, you're interviewing me, and I'm a teacher. This is what I have been doing since 2008.
Yeah.
What I tell my students, it's finding a balance between, yes, you have to have a cash flow. Like I teach my students, don't touch a property if it doesn't generate a cash flow. But if you want a cash flow as an investor, and I don't have the big chart with me when I teach this stuff, but one of the things that I start with, and I think you are the conference, right? The multifamily conference.
Yeah.
So
I saw it.
yeah.
We had a great conversation.
I can find it quickly because I didn't plan on using it. Yeah, here we go.
Yeah.
So the first box is you as an investor. What are you trying to accomplish? So if it's protection of your capital, is it cash flow? What I tell my students, Adam, is find a happy medium, right? If you want a cash flow, all you have to do is put more money down, right? Lower the leverage, the financing, then you're going to cash flow more. However, your cash on cash return on investment is going to be impacted negatively by that. So what I tell my students, it's finding the right balance for the market that you're in based on market conditions where you're investing in all of that. But because to me, but it's understanding, and I'm going to get to your question in a second now, because that's a nice segue. Where is the market going from the moment you buy that asset? Where's the market going? Ideally, you want a market that's ascending, that's going up, right? The fundamentals are strong. So to me, this is just the way, by the way, I teach this stuff, right? And of course we've had a long stretch of very low cost of money. Of course, we know that even yesterday interest rate went up by 0.5 percentage point, but right up until now we had principal pay down that were amazing as another profit source. But why I like Alberta? What are the fundamentals in Alberta? It's a strange world. Like I said, I studied political science at U of T with a major in international relations. I'm well traveled and speak a bunch of languages and all of that. Very worldly, I guess you could say. I don't mean to brag, but I read about international politics all the time. This is what I do. We are in a strange world. We got this war in Europe. Now we know that there's going to be severe food shortages. We are in an energy crisis that's significant, all related to what's going on with Russia, people not wanting to buy the oil in Russia. But we already had an energy crisis that was in the works. Why? Since 2015, 2016, as a starting point where the price of oil went down, and everybody was, crapping all over oil and gas companies, like the end of the world is near, global warming and all of that. Oil companies started not investing in oil production. So we went from a position of oversupply of oil to undersupply of oil. For the last 6-7 years, because oil is not a tap overnight. You turn it on and oil starts flowing. It takes years to get production going. So before even this crisis in Europe and the Ukrainian-Russian war began, we were going into a position of undersupply of oil, which is now exacerbated by what's going on in Russia. So oil is not going away. And I'm not anti. I would call myself an environmentalist. Absolutely, I'm the kind of person that spends his time in the outdoors, hunting, skiing, fishing, you name it, all year round. I'm in the mountains, right? Because I'm in Alberta. But we cannot switch over to greener technologies overnight. It's physically impossible. We don't have the technology. So people need to keep that in mind. So if you talk about fundamentals, the world needs oil like more than ever. Alberta has it. Alberta has the cleanest oil, in the world, the highest environmental standards in the last 10 years alone, Adam. Alberta oil and gas companies have reduced their emissions by, listen to this, 30%. Okay. Edmonton's been declared the hydrogen hub of Canada. The oil and gas companies have invested money, have created a consortium to invest in research and development to further reduce. We are a world leader. The world needs Alberta. Okay, so that's one thing on the fundamental. Oil drives this planet. It doesn't matter how you slice it. You can climb on trees, tie yourself to trees, and to save them and all that. We physically cannot live without oil yet. We need to make that transition. Ain't gonna happen for decades. So this is personally my assessment, and I can send you a ton of information on that and articles from experts and scientists. So first step one. Now let's talk about food shortage. what is the world shortage or is about to be significantly, and this scares me, it's wheat. All right. And guess what? Guess who has wheat? Alberta and Saskatchewan have
Saskatchewan,
wheat.
yeah. Saskatchewan.
Galore. But Alberta
I didn't know
well,
Alberta
like
too. Really?
Yeah, but not to the same extent as Saskatchewan.
Yeah.
But, we also have oil, like canola. There's going to be an oil shortage. You need oil for everything. A lot of countries, just reading this morning about palm oil, like Indonesia and India also is not exporting wheat anymore because they want to make sure that their population. So the same thing with oil. Like a lot of countries like Indonesia, what's the other country? And another country where they grow palm oil, which palm oil and all this oil goes into almost everything. So and I'm done. So you can see where Alberta and Saskatchewan we have, because there's oil in Saskatchewan as well, and there's potash, which is a fertilizer that's needed. So
you mean sustain job opportunities on the market.
Time. And I'm not done. One more I need to give you, my friend. Wow.
Yeah, sure.
Because I mean, if accredited investors listening to me, you can reach out to me at support@multifamilyinvestingcanada.com. Support@multifamilyinvestingcanada.com. If you're interested in investing with me in Alberta. But here's what else does Alberta have. So you're in GTA. You were telling me you're in Mississauga. And as you know, I know the area well. I went to U of T and I have friends and family in Ontario. I'm out there regularly now since COVID is over finally. And that's something people
finally we see faces and we met on the conference. Yeah,
exactly. And if anybody wants a speaker, I'll come out to GTA anytime. But we need, as a result of COVID, we had quantitative easing, right? The printing of a lot of money. We're in debt like never in our history in Canada, right? Home prices are through the roof. They're coming down a little bit. There's a bit of an adjustment. But the fact of the matter is we have in Canada a severe housing crisis, right? There's not enough homes to go around. And rents are horrendously high, especially in GTA, Lower Mainland in British Columbia. Quebec is still reasonable, but overall, like there's hardly any rental units, right? Yeah. Except where? In Saskatchewan and in Alberta, where rents are significantly lower and our vacancy is higher. So you think about that. We need to bring immigrants to, fix the labor shortages that we have across Canada. No difference. It's no different here in Alberta. We have labor shortages in the oil and gas. My kid graduating from high school tomorrow wants to work in the oil patch just as a gap year, right? To make a lot of money. And then after that, I'm not sure what he's going to be doing, but there's like wages, like people that are going to work opportunities at the highest wages in Canada, pretty much in Alberta. Now, we know that the federal government has speeded up the process to bring in Ukrainians, right? Yes. And it's begun. I think the number in Edmonton is going to be 60,000 Ukrainians coming. I have a friend of mine who's going to be volunteering to help them acclimatize and all of that in Alberta. So you're talking about, in terms of fundamentals, you're talking increasing population, lots of work, high wages. We have oil, which is at a ridiculously price, and you haven't seen the end of it. Like, it's going to be very costly for us to travel abroad and drive our cars. So, all the fundamentals are there, bottom line, 100%. Adam. So it's a long-winded answer, but I mean, like you, this is
you finally see I think you see finally the light after 2014, all of the decline of the market. I'm not going to say it collapsed, but it didn't appreciate. But on the last year, the Edmonton market started to see appreciation. As you mentioned, the rest was always there. The cash flow was always there. The only problem was the fundamentals was not clear. But as you mentioned, all of this clear now, and the appreciation. So yeah, it's a great market to invest, to be honest, right now.
It's a bit of a stampede. There's more competition, but
it is.
It is what it is. Like anywhere else, you need to know what you're doing and do your research properly in your planning.
I think there's an actual immigrant investors coming from GTA coming to Edmonton now. Like a lot.
Well, like I said, they're coming here because the housing prices are lower and rents are lower. They're coming here. So demographic growth as one of the fundamentals that we look at from the real estate point of view.
Also, the market is investor friendly. Also, the market is investor friendly.
Exactly. Exactly. The legislation is user friendly. So, like I said, it's finally, it's been a rough 6 years in Alberta, but the good times are coming back. Not to the same extent as before. It's not going to be booms like that were excessive, like in the past, and previously, but it's going to be more sustainable. And the future belongs to Alberta. Mark my words. That's daily. 100%. I do my research like you. So
100%. So my next question is about the actual, not fundamental, but numbers wise. So what is the perfect deal right now, like range wise, when you're looking for a deal? What is the acceptable cap rate for you? What is the accepted? Also, your target project is a BRRRR, like when you do actual forced appreciation or buy and hold. I'm asking this question because I'm trying to ask about what is your criteria, expenses to net operation income wise. So you will always like find an actual opportunity when you find that the actual split is 60% between expenses and net operation income, and you see, okay, on this matter I can enhance the management, I can lower the expenses, then I see an opportunity. For you, what is the actual trigger here on Alberta right now?
Well, I hate to lump everything into a specific category. Obviously, I have been, you want to call it a BRRRR. I'm always looking for an asset that has an upside where, as you said, I can go in and fix the numbers, maybe increase my rents, which is something in Alberta we can do. And then I look at the operating expense side and I see, I try to find ways to shave operating expenses in order to increase NOI, right? My net operating income, which is the driver, the NOI is the driver of valuation. So of course I look for that. But then again, Adam, it depends what you see in the market. I have one of my former lenders used to say, he or she who gets the property is always the one who overpays, right? And all of us, you can ask any multifamily real estate investor, most of us have overpaid at times. But I have one of those that I overpaid by $5,000 a door, which in my book was not much. But at what phase of the market, at what phase was the market at? And it was in an ascending phase. So the $5,000 per door that I overpaid for has disappeared. Now that property, which I paid back then, 2010, I think it was $85,000 a door, is now worth probably $120,000, $130,000 a door, right? So, and it's fully stabilized, no major capex, right? Because I've owned it since 2010. So that's a great asset, okay? But generally speaking, this one, I don't think I got a big lift, right? When you can go in and increase your NOI significantly. But it's steady Eddie. Like this asset is fully stabilized and it's cash flowing and it's almost fully repaired. There's no major capital expenditure. So, but yeah, ideally, but let's say I buy an asset that's fully stabilized. There's no upside. There's no way of improving my NOI, therefore valuation. But my goal, again, going back to my chart here, what's my investment goal, and making sure that my investors' investment goals are in sync with mine. If it's like guys, like a lot of guys that invest with me, it's to protect their capital because they're not so sure about the stock market, right? It's to preserve their capital. And I make sure that I choose very carefully. And I think you and I, before you started recording, since you were talking about the kind of investors that we have, I want to make sure that these investors know that this is a long-term investment. I say at least a 10-year hold, right?
10 years.
Then, as a minimum. And to be honest with you, I would like to keep these assets forever. Like I work hard at the beginning to stabilize them, to replace the roof if I have to, and now I'm upgrading to a higher grade my units with vinyl planks like I have here, nice quality stuff that's more durable. Doing these improvements with more durable materials, then my repair and maintenance expenses go down. If you find people that are in sync with your investment goals, what's wrong with that? The property, we pay the loan down and cash flow keeps going up, and it's retirement money, Adam. So sometimes what I'm trying to say is, ideally, yes, I want to make a good chunk of money by finding a BRRRR type of project where I can go in and fix the numbers and make more money faster, but it's not always a race. And for me, because I have a core group of repeat investors, they know that it's generally speaking a long-term hold, but sometimes you may want to dispose of one, depending what's happening to my life or my investor's life. They want out, but if they want out, we can buy their shares at today's market value as well. So I tend to be a long-term hold to ride the wave because it's a sound asset. And by the way, like I said earlier, I used to manage defaults at CMHC, right, of apartment buildings, and I was bored out of my mind because they rarely default. To this day in 2022, despite the pandemic that we've gone through, that we're still somewhat experiencing because it's not going away. So long-winded answer, but that's what I look for. So if the building makes sense, yes, but I don't limit myself to just a BRRRR where there's a big chunk of money that can be made quickly. If it's a sound asset and my investment horizon and that of my investor shareholders is long enough, then it's a great project. You're in the game. There's always an opportunity cost, right? The cost of not buying the asset, if it's a sound asset in a good market that over time is going to continue to do well.
100%. I think we're gonna go back to the main part here, which is CHMC products for the multifamily. As a former underwriter, I was trying to highlight the main differences between the conventional products and CHMC product. Especially, there's a confusion about when is the best time. And for me, the challenge was with CHMC is how long it take. It's killing me, to be honest.
But turnaround times are ridiculous.
But it's a great product. You can find until 85 LTV, 40 years, but with some
even more now with MLI Select, right up to 95%.
Really?
With MLI Select, let me check that. It came out in March, so I still have to look at the guidelines.
Okay.
Okay.
So if we can highlight the main for you as a former experienced expert on this matter. Beside as a multifamily investor, what is the attraction or what is the main trigger for you to look for a CHMC loan, and what is the pros and cons?
And I want to make sure your listeners, Adam, understand. I'm a former underwriter, but I'm always in the know. Whatever goes on, like I'm, I'll share about MLI Select in a minute. But I'm always in touch with lenders and mortgage brokers. I'm always current because it's my job, and I'm always refinancing a deal, or now I'm looking at acquiring. But when you take my course, and again, you can go to support multifamilyinvestingcanada.com. There's an online program there that you can take. It's 72 hours, very extensive. I know it's the best in Canada because nobody else in Canada has my background, my credentials. So a lot of people are copycats, graduate students of mine, who shall remain nameless, but I gave you those names. They all came through
between me and you.
They all came through my course, and I know they're using my stuff. But I give you a chart. This CMHC versus conventional financing. So I think your question basically you focused a bit on CMHC, but it's what's the difference between CMHC insured financing versus conventional financing? Adam, is that what I understand? So conventional financing, let's start with that. It's non-CMHC insured loan. So again, just to go back to CMHC, CMHC does not provide money financing, but the banks provide financing, provide you with the money to buy your assets, to invest in your multifamily properties. What CMHC does, they come behind and they insure the lender's loan against default by investors or borrowers, if you will. Okay, so that's what we call mortgage default insurance. If, as an investor, I default on my mortgage payments and the loan is insured by CMHC, whatever losses the bank has, CMHC will pay the lender's claim against whatever loss occurred as a result of the default by the investor. But conventional financing is non-CMHC insured. Therefore, there's no insurance to protect the lender. So the underwriting guidelines are going to be different. First of all, the maximum loan to value is going to be 75%. Of loan to value. Good news is the value that the conventional lenders will use. So when I say conventional lenders, that means the loan is not insured by CMHC. So it's 75% loan to value, up to 75% of the value. What value? Generally speaking, with conventional lenders, they will take the actual appraised market value. So that's one key difference. The other difference as well, conventional financing, the maximum amortization period is 25 years. So at large, and the other thing too for conventional financing, still before I move on to the CMHC insured financing, your interest rate, generally speaking, is higher on the conventional side by roughly, on average, 1%. So that's a significant negative impact on your return on investment. So that's conventional financing. Whereas on the CMHC insured financing side, the maximum loan to value is generally 85%, unless you go for MLI Select, which just came out in March of this year, which can go up to 95% loan to value. We'll come back to that after a little bit at a high level, okay, Adam? But let me just finish the two distinctions between CMHC. So 100%. CMHC instead of 75% loan to value for the conventional side, you can go up to 85% loan to value, so you can borrow more money. However, which value that CMHC uses is usually lower than market value. Although since January of last year, CMHC now requires you to provide an appraisal for apartment buildings between 5 and 24 units. So because of that, since last year, whatever value CMHC will use tends to be a little bit closer to market value, but not always. I wouldn't necessarily count on that, okay?
But so for bigger buildings, the same. They need also appraisal, even if it's more than 24.
Well, not necessarily for a larger building, the roof. But at any point, CMHC can decide to do whatever they want. But generally speaking, between 5 and 24 units, you need an appraisal, which is new. Until last year, January of last year, 2021, wasn't necessary, okay? So that's the second difference. So just be careful. Yes, it's higher loan to value, but what value? CMHC tends to lowball value, whereas the conventional lenders, they give you market value, generally speaking, okay? And I cannot speak specifically because every time you submit a deal to the bank, whether it's CMHC or conventional, they will look at it based on its own merit. So I can't lump everything into one box.
Usually,
every deal is analyzed.
Usually, if you're like in the market value is like 3 million, CHMC is going to appraise it for 2.7, 2.6.
Yeah, it tends to be very conservative on value. So the first thing, so higher loan to value for CMHC up to 85% or 95% if you go with this new product, MLI Select, which we'll circle back in a moment. And then the other thing too is that the maximum amortization for CMHC, it used to be 40 years. Now with MLI Select, I think it's up to 50 years, okay? So whereas conventional financing is only 25 years. And what else? Maximum loan to value is 85. We've talked about that. And the interest rate is 1% lower on average than conventional financing. So at large, Adam, those were the and turnaround time. Okay,
this is the main problem.
It is a main problem, but it's improving somewhat. But if you want a deal improve quickly, you don't go CMHC insured financing because, as Adam said, it takes forever to get approved. It was hell when COVID began. It's improved now. I understand it's continuing to improve, but be careful. If you want to close quickly on a deal, you never go with CMHC insured financing. Okay, you need to go with conventional financing. Probably with
during COVID was 6 months, 7 months.
Insane. I've been there, done that. I know. I've been there. No, and my financing applications are perfect. Like I knew what I'm doing. I used to be the guy telling banks, your financing application is not complete. So, but it's better now. It's improving. But as long as people understand, if you need financing approved quickly, you never go CMHC. You're going to go conventional financing, which is non-CMHC insured financing.
I think the CMHC is perfect for refinance. When you have time, when you have the property already stabilized, you can apply for CMHC after you add value or after you acquire the building, but not to buy, not to acquire.
I would tend to agree with you on that one, Adam. I generally speaking, longer closing, there's nothing wrong with that. But if you go with conventional financing, usually it's a bridge loan for a short term, usually 12 months. But this is the kind of stuff I teach, obviously, as well in my workshop.
So my next question will be raising capital, and how was the raising capital journey for you? How you started? What was the main trigger to able to attract or show? Because raising capital is not, we're not looking for money. We are giving an actual opportunity to our investors, and they basically invest in their trust on us and our performance. So when is this started with you? And when you said basically this is another question, to be honest, a separate question, which is what you prefer is equity partner or debt partners, like going with hard money or more like equity partners where you have more passive investors.
So the latter. So for me, they're all equity investors.
No.
And I know you and I both know, because we both raise money privately. It's the biggest hurdle that people face that prevents them from investing is obviously finding capital. Yeah. But it's all in the mind. Anybody can do this. But I was lucky in that regard because my expertise is how to assess the risks pertaining to investing in apartment buildings, because I learned that at CMHC in order to insure them. And of course, CMHC doesn't like to pay claims. To be honest with you, they very rarely pay claims on apartment buildings. Why? Because I told you, they rarely default. This is a sound asset. I've been through two recessions, I guess 3 recessions now, and they are a sound asset that rarely defaults. Yeah. So I was lucky there in that regard to begin with when I started attracting capital, because I knew how to assess these assets and mitigate the risks, and therefore I was able to pitch deals to a core group of small investors, high net worth individuals, usually in the medical profession, to invest with me. But they're equity holders. And again, going back to my criteria, how I choose investors is I make sure that they're in sync with my investment horizon, which, as I said, is a long-term hold, ideally. Okay. Yeah. Once in a while, you sell an asset if it makes sense, or you need more cash or whatever. But generally speaking, I'm in it for the long haul. I'm looking at this as income-producing assets in my retirement, and I want shareholders and investors that think the same way in that regard. So, but you just got to know. So, for somebody that doesn't have the prior experience that I had when I started attracting money. Again, this is something that all this first column in the org chart is planning and research. You need to do your homework. Yeah. Like you cannot go out and try to raise money if you haven't done your homework. That's the worst thing. Your credibility is going to be shot right away. Even with the stakeholders in the business, the realtors, the mortgage brokers, the lenders, you need to prove to people and prospective investors you've done your homework. It's as simple as that, and that requires you to roll up your sleeve and do the homework. It's not something that happens overnight. Like if somebody says I'm going to start investing in multifamily overnight, man, your mindset is in the wrong place. Very much so. That's scary. And the first one, would not invest with you if you haven't done your homework.
One of my homework always at the start when I talk to anyone. I'm ready with all of the market fundamentals, number wise, even if I'm sure that he's not going to ask about it, but I have to show them how I managed to select this market. And as you mentioned, it's a lot of work. You have to be trustful. You have to show track record, your team, how you did it before, how you went, what was the hiccups. You have to be transparent, because this is not attracting is trust. If you lost the trust.
Yeah, so, trust is everything. Yeah, absolutely. 100%. Trust is everything. Yeah.
So
that's what I would say, Adam. You got to do your homework somehow, somewhere.
Yeah, 100%.
But
100%.
That's super critical. That's how you attract and trust, as you say.
So
and money, capital.
My next question about the structure: how you structure your deals with your inner circle, basically, successfully. Because I like what you did is you don't want to complicate things. It's working. It's been a long time with you. So how you structure your deal, like with your investors, legal wise?
Yeah, I at the beginning, the first deal or two, I think they were just simple joint venture agreements, right? Yeah. That spell out the rights and obligations of the parties and who's the lead manager and who does what and who manages the daily operations of the asset and the property manager and all of that. And then I moved on to, it's not significantly different, the simple joint venture agreement, the JVA, but to a unanimous shareholder agreement. Yeah. Same idea. It specifies the obligations and the responsibilities of all the parties. And, if a shareholder wants out, how they can get out, and, right of first refusal, all these things that are standard in these agreements.
Yeah.
But I did not, I've been a speaker for a long time, since 2008 across Canada. But I was always careful not to get involved with the Securities Commission, obviously.
100%.
So it's always people from my inner circle of people who came to me and approached me. But generally speaking, they were close friends, and they were, like I said, high net worth individuals. With
this is the best thing anyway, because the people are
well at the beginning, right?
Yeah.
I think it makes sense.
Yeah.
Now, like I think I was sharing with you before you started recording the interview, that I'm looking at maybe a more sophisticated model, which is not that complicated, but it's more costly to set up, which is the GPLP model. But it's not necessary. And like you said, you quoted me earlier, I try to keep things simple, right? I don't want to have, I try not to have a ton of investors per deal. But again, it depends with the size of the deal. But I try to keep every property has only a handful of shareholders. Literally, 100%. I don't need 5 fingers even.
I think the price is huge too. Like you're comparing between 3, 4, 5,000 to 30,000. So on the legal wise,
and because otherwise it becomes too political. Issues will always arise. You got to be strong. This is it's investing, right? Issues will arise in the marketplace, sometimes with the property. Although this is where I do a pretty good job of assessing properties. I usually don't have a lot of surprises. But mind you, the last 6 years in Alberta have been a bit of a surprise, because I didn't understand the oil and gas industry like I do now. So that's,
I think the next question will be about coaching and courses. Tell me how you started to understand or like realize that you think that it's you have the ability to help people, and how does this help your business and help around the people, the network around you? Because as we mentioned, like some people are using your courses, you're helping people. You got already this, I think, from understand the advantages of having an actual influence on the market. But when you started to realize, okay, I want to start doing this?
Well, obviously, like people start teaching, it's also one way of attracting capital, although I don't think, I do have some shareholders that took my course, but they took it after. So they wanted to understand better how I was doing. So it's not how I attracted investors. Okay. So I want to specify that. 100%. I was really out of my, my mission, Adam, is to democratize the access to multifamily investing in Canada. And I think I've done a darn good job at it, because a lot of my students are successful. They use the systems that I teach, which is essentially all these charts that I have, right? And by the way, the course, this is the last rating from the March course. Out of 10, it's 75% gave me a 10 out of 10, and 21.4% gave me a 9 out of 10. I've been doing this for a long time, and this is the students' evaluation, not mine, right? But no, I want to help people create this. I think all of us, when we're successful, it's a natural need to share our success and help others. I believe in helping people create wealth for themselves, and my hope is that there will be a ripple effect, and people will help others create wealth in turn, and do good in the world. You know what I'm saying? So this is truly what I believe, and I've been doing this for a long time, and a lot of my students are very successful. So that's one thing, one desire. It is a bit of a sideline now. Obviously, I can use this to attract capital, but I'm very picky who I want to invest with me. Like, again, but it's just that's part of my mission. But unlike a lot of people that are out there, this, Adam, I'm not always on the internet. I'm not always vlogging, because I have a life. I invest in real estate to create a life for myself, and I like the simplicity of my life. I travel a lot now that
you like hiking.
I like hiking. I'm going to be next week. I'm going to be spending the week with my wife in Portland, Oregon, just for the heck of it. I'm a foodie. It's a foodie town. Portland. Was in Mexico swimming with shark whales in February with my wife, and I'm going to be mountain biking the following weekend when I come back in the mountains, and my wife and I have e-bikes, mountain e-bikes. So it's just trying to keep, but helping people without keeping, like, I'm not a big freaking marketer. And it shows, there's people that it's their life to be online. It's not my life. It's a portion of it, but I like to help people succeed 100%. As well, because I have good success and a good life. I'm very blessed.
I think my last final question, technical one, was what you can say is your strengths and superpower.
Oh, that's a goodie. Well, I when you do something like this, it's I don't know if I have it here, the Malcolm Gladwell book, the 10,000 hour. Let me see if I have it here.
Sure. Take it out.
Do I have? Yeah, it's right here, because I gave it to my son. He hasn't read it. Sorry if I disappear from the camera for a second, right? But it's The Outliers, right? That book by Malcolm Gladwell, and it's sort of the theory that if you spend over 10,000 hours doing something, like they quote the Beatles or people who play sport, then you get really good at it. So I think I'm a very good teacher to simplify, to teach this to people how to invest in apartment buildings, because, after a while you start creating very great tools, very clear. This is the financing overview, different financing strategies depending on the situations that you're encountering. So I think that's certainly a strength of mine as a speaker and teacher, and also as an investor. Like, I have my nose, I stick to what I know. I'm a cautious investor. So I'm talking about if people want to invest with me, for example. And again, I'm looking for accredited investors to invest with me in Alberta for the reasons I've described. The fundamentals in Edmonton in particular, in Alberta, are very strong for years to come. But I'm cautious because of my background as a former CMHC underwriter. So I think that's a strength as well. I think these would be my strengths as a teacher.
Your leverage your leverage as a previous game player on the underwriting, and current player on the actual market. So both.
Exactly. And remember, I used to manage defaults. So there weren't too many defaults, but there were some defaults. So I know what can lead to defaults and how to get around to prevent that. And again, goes back to what we were talking about earlier, like, okay, cash flow, but you also want your cash on cash return on investment to be, so finding a balance. But I'm a specialist. I have my nose daily, day in, day out. I talk to people in my marketplace. I know what I'm doing, right? I don't take it for granted. I'm not a passive investor. My investors, my shareholders are passive investors, but me, I'm in the know, making sure I know everything that's going on in my market where I invest.
100%. So my final question will be, how the people can follow your success?
Yeah, so they can. So if people are interested in my courses, they can go to Multifamily Investing Canada, MIC, multifamilyinvestingcanada.com. The courses are there. I just had one in March. Probably will have one in October. Since COVID, we're all, I've got nice fancy cameras like you here.
It's online world.
We do this virtually. I may do one in person. If I do so, I used to have one in Hamilton as well as in Edmonton.
Hamilton.
Hamilton. Yeah, I used to have a workshop in Hamilton for years. It was very, very successful as well. I don't think I'll have one in Hamilton. If I have one in person again, it's going to be in Edmonton, because the way I teach, by the way, this is super important to Adam, is experiential. So we use case studies, real deals, one of mine, some additional case studies as well, and we crunch the numbers and we look at what the due diligence documents look like. We go through all of these and how I conducted my due diligence, my market analysis. So it's very hands-on, experiential teaching and learning is what I do. So when I do it in person, if I do one in person again, but more likely it's going to be virtual, because I think it works really well virtual. But if it's in person, you come and visit, you do a full building inspection accompanied by a professional building inspection of an apartment building. Then we come back to class and we crunch a bunch of numbers. So you can find these courses at multifamilyinvestingcanada.com. And otherwise, so subscribe. You can subscribe. There's a wait list for the next course, which I think is going to be, like I said, in October. And if you want to reach out to me as a potential accredited investors. So you can reach out to me. You need to have a certain income. Usually every jurisdiction is different, but it's over a couple $100,000 a year and all that. But you can send me an email at support@multifamilyinvestingcanada.com. support at multifamilyinvestingcanada.com, and we can chat about it if our investment horizons are in sync, if our investment goals are in sync. But like I said, there's some good times to be had. I'm actively pursuing new acquisitions in Alberta in the next few months.
To be honest, it was fun today to have an insight from expert of Edmonton, and I appreciate you took the time, and we're really happy to bring you again to the show.
Well, it's my pleasure, Adam. Thank you so much for having me, and wish everybody out there, a great summer. I know mine is starting on the good footing. So thank you so much for having me, Adam.
Thanks
Cheers.
a lot.